For 9 years, a man in Boston sent the American government written proof that the world's most trusted investor was running a fraud. He sent it 5 separate times. Each time, they read it, and did nothing. December 10, 2008. A penthouse on Manhattan's Upper East Side. An old man in an expensive cardigan sits down opposite his 2 grown sons, the sons who work for him, in his company, on the 19th floor of a building shaped like a lipstick tube. Outside, the city is in the middle of the worst financial panic since the Depression. He tells them he wants to hand out the employee bonuses early. They ask him why. He does not answer in the office. He takes them home. And in the living room of the apartment, with his wife standing there, the most respected money manager in America tells his own children that everything, the firm, the fortune, the returns, all of it, for decades, is, in his words, one big lie. He tells them he has about a week before it collapses. Then he tells them the number. $65 billion. Not lost in bad trades, never invested at all. And here is the part that should frighten you more than the theft: this was not a genius no one could catch. The evidence had been handed to the regulators, in writing, again and again, by a man who had worked it out with a pencil in under 5 minutes. This is the story of how the largest fraud in history survived, not because it was clever, but because nobody wanted to look. Bernard Lawrence Madoff was not a man on the edge of Wall Street. He was Wall Street. He had helped build the Nasdaq stock market and served as its chairman. He sat on regulatory committees. Investors did not chase him, he made them beg, and turned people away to make the door look smaller. That reputation was the machine. The returns were only the bait. And the strangest part is that half of his company was completely real. On the 19th floor of the Lipstick Building, Madoff ran a legitimate and genuinely important business, market making, matching buyers and sellers of stock, at one point handling a large share of the daily volume on the New York exchanges. It was profitable. It was respected. It employed hundreds of people who knew nothing. The fraud lived 2 floors below, behind a locked door, on the 17th. The 17th floor was a different world. A handful of loyal staff, some hired straight out of high school with no finance background, ran the entire fictional operation on ancient IBM computers deliberately kept off the firm modern network. Their job was to manufacture history, producing trade confirmations and account statements for transactions that had never occurred, choosing prices after the fact from the day real market data so every invented trade looked perfectly timed. The scheme itself was the oldest trick in finance, and the simplest. A Ponzi scheme does not invest anything. New investors' money is used to pay the old investors their profits. As long as more money comes in than goes out, the arithmetic holds and everyone sees beautiful statements. The moment the flow reverses, the whole thing evaporates in days. Charles Ponzi ran it for 8 months in 1920 before it broke. Madoff ran it for decades. What made his version survive was not complexity, it was the returns. Madoff never promised spectacular numbers. He promised something far more seductive, about 10 to 12% a year, every year, in good markets and bad, up in the crashes, up in the booms, almost never a losing month. Any professional looking at that line should have felt their skin crawl. Markets do not do that. Nothing does that. It was too smooth to be real. There is a detail here that fraud experts still find remarkable. To forge statements convincingly you must be careful, and the 17th floor was not always careful. Investigators later found trades dated on days the markets had been closed, and prices outside the range the stock had actually traded that day. The evidence of forgery was sitting inside the paperwork the whole time, waiting for anyone who cared to compare it against a newspaper. He also built the perfect social lock. He recruited through country clubs, charities and synagogues, the Palm Beach Country Club, Jewish philanthropies, university endowments. Being allowed in was a status symbol, asking hard questions was rude. Whole communities were pulled in by trusted friends, one dinner at a time. Later, this would earn its own grim name in fraud textbooks: affinity fraud, stealing from people who trust you because you are one of them. And the money did not arrive one retiree at a time. It arrived through feeder funds, investment firms that raised billions from clients and shoveled it all into Madoff, collecting fat fees for the privilege. Some of the biggest names in European and American banking sold their customers a product that was, in reality, a single account with one man in New York. Several were later accused of ignoring the same warning signs the skeptics kept whispering about. Their incentive not to look was measured in fees. Now meet the other man in this story. Harry Markopolos was a numbers analyst at a rival firm in Boston. In 1999 his bosses handed him Madoff's performance record and asked a simple question: "Can you copy this?" Markopolos studied the return stream. Within roughly 5 minutes, he said later, he knew it was mathematically impossible. Within 4 hours, he could prove it. The proof was almost embarrassingly simple. Madoff claimed to be using a strategy built on stock options. Markopolos calculated how many option contracts that strategy would require at Madoff's size, and the answer was more contracts than existed in the entire market. The trades could not be happening, because there was nothing to trade. It was not a clever fraud. It was a fraud that had never been checked. So he did what you are supposed to do. In May 2000 he walked his analysis into the Securities and Exchange Commission's Boston office. He went back in 2001. He filed again in 2005 with a document whose title left nothing to interpretation: "The world's largest hedge fund is a fraud." He filed again in 2007, and in 2008. 5 submissions. 9 years. Each time, the case went quiet. The SEC did not entirely ignore Madoff. It examined him. Investigators walked into his offices, asked for records, and were handed documents he had fabricated for exactly that purpose. Junior staff were assigned, senior fraud experience was not. They asked whether he was front-running trades, the wrong crime entirely. One reported chance was almost absurd in hindsight: a single phone call to the clearinghouse that settles securities trades would have shown, instantly, that the trades did not exist. Nobody made the call. It was not only Markopolos. Inside the industry, Madoff was an open secret among the skeptical. Sophisticated firms that examined the operation quietly refused to touch it. Risk managers wrote internal memos calling the returns implausible. At least one major bank concluded something was badly wrong and simply decided not to invest, without warning anyone else. The professionals who worked it out protected themselves, and left everybody else in the dark. Markopolos, by then, was frightened. He was convinced that if Madoff learned who was hunting him, he, or the investors he had exposed, might come after him. He checked his car. He avoided using his name. He would later tell Congress that he had believed the government would either act on his evidence, or that his evidence would get him killed. Instead, for 9 years, it simply produced silence. In 2006 the regulator came closer than at any other moment. Investigators questioned Madoff under oath, and he made a mistake. He gave them the account number of his firm at the Central Clearing House, the institution that records who actually owns what. A single request to that clearing house would have shown the account held almost nothing, and the fraud would have ended that week. The examiners wrote the number down. Nobody ever sent the request. What finally killed the scheme was not an investigator. It was arithmetic. In 2008, as the financial crisis tore through the markets, Madoff's clients began asking for their money back, around $7 billion of it. In a real fund, you sell assets and pay. In a Ponzi scheme, there is nothing to sell. The inflow had reversed, exactly as the mathematics said it must one day, and the machine had days to live. His final week has the quality of a man tidying up. He tried to spread the last of the real cash to family and favored friends. He arranged for hundreds of millions in bonuses to go out to loyal staff. And on the day before the confession, the last statements went out, envelopes full of numbers that were by then entirely imaginary, landing in mailboxes across America while their owners still believed they were rich. Which brings us back to that apartment on December 10th. The next morning, his sons walked into the FBI. Agents came to the penthouse, and one of them asked Madoff whether there was an innocent explanation. He said no. He said there was no innocent explanation. This mugshot was taken 3 months later, after he had pleaded guilty to 11 federal charges, without a trial, without a plea deal, without naming a single accomplice. The sentence was 150 years. But the number that matters is not the sentence. It is what was actually left. Of roughly $65 billion on the statements, only about $20 billion had ever really been deposited by investors. The rest was fictional profit, money that never existed, on paper people had used to plan their retirements, their children's schools, their charities' entire endowments. He never explained the arithmetic of his own crime, and prosecutors never fully accepted his claim that he acted alone. Over the following years several of his employees were convicted, including the man who had run the 17th floor and the staff who typed the fake trades. His brother, the firm compliance officer, went to prison too. His surviving family lived out the aftermath in public, assets seized, names ruined, a household destroyed from the inside. The wreckage was not abstract. Charities that had trusted him closed their doors within days. University endowments were gutted. Retired people in their 70s and 80s, who had put everything with the nice man from the club, went back to work or moved in with their children. At least 2 investors took their own lives. And Madoff's own elder son, Mark, hanged himself in his apartment 2 years to the day after the confession. Some of it came back. A court-appointed trustee spent more than a decade clawing money out of the people who had taken more out of the scheme than they put in, and recovered a remarkable share of the real deposits, over $14 billion. But recovery is measured against what was really paid in, not against the statements. For most victims, the fortune they thought they had simply never existed at all. The victim list read like a strange census of trust. Hollywood actors and baseball owners, the foundation of a Nobel Peace Prize laureate, which lost nearly everything it had, hospitals, schools and charities that had grown for generations. But most of the names were nobody famous, dentists, teachers, small business owners, widows handed the account by a husband who had done the research and been reassured by the same 3 words everyone used about Madoff. He is completely safe. What changed afterwards is real, if incomplete. The regulator was overhauled, specialized fraud units, mandatory verification of assets with independent custodians, and a whistleblower program that now pays people who bring credible evidence instead of losing their paperwork. Markopoulos, the man they ignored for 9 years, testified before Congress in 2009 and told them in public exactly how badly they had failed. It is the single most useful thing to come out of the whole disaster. So how did it last so long? Not because it was sophisticated. The internal report that followed was brutal about the regulator, credible, specific complaints had arrived and been mishandled, examiners had never verified the trades with an independent source, the agency had been dazzled by who Madoff was rather than what his numbers said. He was the former chairman of NASDAQ. He sat on the committees. He was, in the most literal sense, too respectable to check. And that is the thread running through every case in these files. Barings did not fall because one trader was a genius, it fell because nobody checked his own paperwork. LTCM did not fall because the maths was wrong, it fell because everyone believed the maths could not be wrong. The insurance industry did not fall to Hurricane Andrew because the storm was unimaginable, it fell because they had never bothered to imagine it. Madoff is the purest version, a fraud that any auditor could have broken in an afternoon, protected for decades by the fact that he was somebody. And the pattern keeps repeating in miniature. Every year smaller Ponzi schemes collapse on exactly the same three ingredients: returns too smooth to be real, an operator everybody vouches for, and money nobody independently verifies is actually there. The name changes. The arithmetic never does. If someone shows you a line that only goes up, the correct question is not how. It is who is holding the assets, and who has checked. Madoff died in prison in 2021, still refusing to explain when exactly it all began. Some investigators believe the fraud ran back into the 1970s, which would mean that for more than 30 years, every statement he ever sent was fiction. So here is the question I'll leave you with: if a man handed the government written proof, 5 times over 9 years, and nothing happened, what exactly is protecting your money right now? Tell me in the comments. And subscribe, because on this channel, the ledger always comes due.